Hi everyone. I hope we had a very blessed crossover. You have a good Christmas and wishing you all the best for 2025. So in this video, I'll be showing you a couple of examples of our 7-Eleven model. You can check on our previous videos. We did live execution using the same model. So basically, this is the 7-Eleven model derived from a KLab model from ICT. So I'm just gonna show you like four different example for the past 2 days from yesterday, which was Thursday the 2nd, to today, which is Friday the 3rd of January 2025. So our model is called Ambition 7-Eleven Model 2024. Ambition 7-Eleven Model 2024. So as I said before, is inspired by ICT KLab model, which we do in a different way, but they have found this model and it's really helping me a lot. So first thing I do is to mark out the 1 a.m. candle, which at this point is 1 a.m. We use 1 a.m., 7 a.m., 13 hours and 19 hours candle to find the relative lows and high. So this low become valid because the price went to this low and it went high. So immediately when the price has moved away, shift away from this low, it makes this low to be valid. So we have this low, we have this high. So now this is a high and low for during this 1 a.m. model. So when price is like this is still on a consolidation. So we wait for price to run on either the buy side PD array, which we don't have here on the previous data, or the sell side PD array, which we have here, which this is the 1 minute reclaim fair value gap. When I say reclaim fair value gap, it means the price did balance this fair value gap here, but it went back to it again. So it reclaimed this fair value gap to become the run on liquidity to come to it. And when price get to this low here, we target the second standard deviation, which we measure it using our Fibonacci. So we have our mentorship, we have deep dive on this model to show you the basics and how it works. Even our Fibonacci, it has its own specific level to give you the specific direction on where price is likely to go to. So using this low here and this high as the range that took out the sell stop, because if you can check from this high here to this low here, is the range responsible for taking out this low here. So we're using this range to mark the second standard deviation, which is where the price has run to. So from here to here, this is basically our delivery for our 7-Eleven model. I'm going to show you more of these examples on how it moves and how this price is valid for every single day, every single specific time, and a specific price action. So I'm going to move to example number 2. Yeah, so this is example 2. Same concept as example 1, different day, just a different day, different time. So here we have our 7 a.m. candle, 7 a.m. candle, 2nd Jan 2025. So as you can see, the price went to create a displacement here, leaving this fair value gap unattended. So this is where you look for relative equal high and relative equal lows, because we have this low here and this low here. We have, we have this high here and this high here, and we have this low here and this low. Okay, let me start off. Okay, so this is our second example then. As you can see, the price consolidated and created a displacement. After doing that, it created this relative high, this one here and this one here. Then it created relative low, which is this one here and this one here. So it makes the model, our 7-Eleven model, to be valid because it has the relative highs and it also has the relative lows. Above these relative highs, we have a fair value gap here. Below this relative low, we don't have any valid fair value gap here. So price went to this fair value gap here. After doing that, it traded lower, and as always, we use our second standard deviation, our Fibonacci. We measure from this low, this high here, to this low here. So as I told you on the first concept, that when we measure the deviation, we measure from the range where price is responsible for taking this buy side liquidity. So this is the second standard deviation where price really ran to it, and the TP is right here. Some will be able to continue lower, but this model is only valid for, it's a pre-market model. So the market is opening at 9:30, which is around here. But before 9:30, before any volatility, before any ups and downs that are happening between 9:30 and an AM session, we already have our model and it's already traded to. This is where we just call it a quit, because if you can get this model, you can find consistency, you can find a very clean price without any disturbance. As you can see, this price from this fair value gap here to the second standard deviation is like on the same level as the sell side liquidity here. So the same time, we have a specific time, which is 7 a.m. and 1 a.m. The specific price action, which the price consolidates and run to one side of liquidity, and press a specific measurement from this level here to this level here. We measure it with our Fibonacci, and it leads us to our second standard deviation, which is the sell side liquidity. So this is a second example that occurred yesterday, Thursday, at 7 a.m. in the morning. So we're gonna move to our third example. Yeah, so this is example number 3. So basically the price did exactly the same thing. We marked the candle, which is the 1 a.m. Remember on the previous example, it was the second at 7 a.m. On Thursday. So this one was on Friday, the 3rd January 2025, the 1 a.m. candle, which was on a London session. So we marked the London session low. As you can see, we have this low here, this low here, this low here. Price didn't run to it. Retailers are gonna think this is a resistance or support level which they use, but no. The most important thing in this part is time, because price has specific time to run on specific liquidity, to run on specific inefficiency, which is this fair value gap. So as you can see, at 1 a.m., price created the low and it ran from it and it created this high. Then it came down to take out the sell side liquidity, which it has this other liquidity that's being occupied here. So price took out these lows here, and then it ran to the second standard deviation, which if we can measure, same example, because this low and this low is responsible of taking this sell side here, we're going to measure from this low up to this high. So this is our second standard deviation, which price was able to run from here to there. And our model is basically the same every single day, the same concept, the same time, same everything, even the same takes handles that the price can give. Because from, if you can measure from here, oh, what just happened here? Okay, if we can measure from here to here to this high, it gives you like 4.9 pips, 4.96, which is close to 5 handles. And this it's big money if you can be able to trade using a good lot size, using your your same target, same everything, specific time, specific model. So I can give you a lot of these examples, a lot of them, where price is doing exactly the same thing over and over again. So it's more wise and it's more easier for a person to find a specific or one thing that repeats over and over again. It's like going to work. You know, when you go to work, what time is your lunch, what time are you supposed to send the reports, what time everything happens. So basically this is exactly what's happening in the market. It's algorithmic. It has specific algorithm which delivers the price in a specific way in each and every specific time. So I hope these examples will able you to change your trading and find consistency in 2025. We have our private mentorship where we teach people how to trade like this every single day. We teach discipline. We teach every single thing you know about the market. We also have our free ebook where we explain deeper into this model. These lessons that I'm showing you right now, it doesn't make it easy for you to find this example, because already these things, the price already delivered, like in hindsight, because already price did deliver everything that I've shown you. But we do have our live executions in this YouTube channel. We do this live execution every single day. So if you want to be part of our mentorship, you could just click the link in our bio. It's gonna send you straight to our WhatsApp, or you can just leave a comment right here so we can be able to be in touch with you and be able to show you this specific model that can show you consistency and show you a certain pattern that repeats every single day. So I'm hoping you can find these lessons insightful. So till our next video, we're gonna be making a more of our live executions, but because it's January, the market is really not giving that it's supposed to. But we're gonna be able to make a lot of executions. We're gonna make a lot of teachings, and there's more detail into this than what I'm telling you in this lecture. But yeah, see you in our next video. I hope you have a very wonderful year and have a blessed trading.